33%. That is how much silver crashed in a single trading session on January 30th, 2026. The white metal plunged from above $121 per ounce all the way down to $76 in what traders are now calling the worst silver day since 1980. Weeks of gains wiped out in just 48 hours. And here is what makes this truly remarkable. As I record this, silver has already bounced back above $83, and major investment banks are telling their clients this crash may have just created one of the best buying opportunities of the decade. If you want to stay ahead of moves like this before they happen, hit that subscribe button right now, because we are about to break down exactly what caused this historic collapse, where silver is likely headed next, and the specific price levels you need to watch. Let me give you the exact timeline of what happened, because the details matter. Silver entered 2026 on an absolute tear. The metal had already delivered a stunning 150% gain throughout 2025, outperforming gold and making it one of the highest performing assets of the entire year. By late January, silver broke above $100 per ounce for the first time in history. On January 29th, it hit an all-time record of $121. Retail investors poured a record $1 billion into silver funds in January alone. Trading in the silver ETF called SLV nearly matched the entire S&P 500's main fund on January 26th. Reddit forums were buzzing with 20 times their normal chatter about silver. Everyone thought they had found the trade of a lifetime. Then came Friday, January 30th. Within hours, silver crashed from above $121 down to $76. A 33% wipeout in a single session. Gold dropped 12% on the same day. This was the largest single-day decline in precious metals in over 4 decades. So what triggered this historic sell-off? The immediate catalyst was President Trump's announcement that he intended to nominate Kevin Warsh as the next Federal Reserve Chair. Warsh is widely viewed as an inflation hawk who has previously displayed strong views against a large Fed balance sheet. Markets perceived this as a signal of potentially less aggressive monetary stimulus going forward, and non-yielding assets like silver took the hit. But here is what most people missed. The crash actually started about 3 hours before that announcement. The real mechanics behind this collapse were far more complex. The CME Group raised margin requirements on silver futures contracts twice within 1 week heading into the crash. For silver futures, initial margin requirements rose to $25,000 per contract. With silver at approximately $75 per ounce, a standard 5,000 ounce silver contract carries roughly $35,000 in notional value. That represents approximately 15 to 1 leverage against the margin requirement. When those margin calls hit, highly leveraged speculators had to either pour massive amounts of capital into the system or close out their positions instantly. Most chose to sell, and selling begat more selling. The Shanghai Futures Exchange implemented multiple rounds of restrictions throughout January as well. Add in the fact that January 30th was the final trading day of the month, when liquidity typically thins and price moves become exaggerated, and you had the perfect storm for a cascading liquidation event. Now let us look at where silver stands today. As of February 9th, 2026, silver is trading around $80 to $83 per ounce. The 52-week range now spans from about $29 at the low all the way up to $121.78 at the high set on January 29th. Despite this brutal correction, silver remains up approximately 160% over the past year. In other words, even after losing a third of its value in 1 day, silver is still more than double what it was trading at 12 months ago. Technically speaking, silver found strong support at the 50-day exponential moving average near $70.81, which coincides with historical peaks from late 2025. According to analysts, if silver holds this area and allows markets to calm, we should expect a demand response rather than continued supply pressure. Even if selling continues, silver has substantial support ahead at the 200-day exponential moving average around $55 per ounce. Here's what the major investment banks are telling their clients right now. UBS strategists said they view the sell-off as normal volatility within a continuing structural uptrend rather than the end of the bull market. They forecast that spot silver will return to the $100 threshold by next month before falling back to $85 by the end of the year. Goldman Sachs expects silver to average between $85 and $100 per ounce in 2026, viewing it as the primary strategic metal of the green transition. Citi has issued a target of $110 for the second half of 2026, citing an acute shortage of physical silver available for immediate industrial delivery. On the gold side, which directly influences silver, JP Morgan analysts expect gold to reach $6,300 an ounce by the end of 2026. That represents a 30% gain from current prices. Goldman Sachs has a $5,400 price target on gold and sees significant upside risk to that forecast. Bank of America has an even more bullish $6,000 target, but I want to give you the counter argument because you deserve the complete picture. UBS warns that high silver prices reduce industrial demand. With more than 50% of demand linked to industrial applications, current prices are likely to result in reduced industrial demand over time as end users seek to optimize silver usage and lower input costs. Goldman Sachs analysts were warier of silver than gold, specifically because of supply constraints in the critical London market. Legendary commodities trader Peter Brandt, who has been trading futures for 50 years, predicted this crash before it happened by comparing the parabolic spike to 2011's top, which he also accurately called. He believes we could get a snapback rally before another wave lower that washes out speculators, setting the stage for more durable gains. His exact words were that 2026 is not 2011, and that he believes there is more ahead for silver, but not until the hotshot know-it-all bulls are thoroughly washed out. Former JP Morgan strategist Marko Kolanovic, who was inducted into the Institutional Investor Hall of Fame, had predicted a 50% reckoning for the metal. Now that the crash has occurred, both Brandt and Kolanovic have switched gears and are tactically shifting bullish. Let me explain why the fundamental case for silver remains intact despite this volatility. Central banks purchased 248.6 tons of gold in the first quarter of 2025 alone, the highest quarterly purchase ever, and that momentum carried into 2026. Central banks from China, India, Turkey, and Poland are still buying massive amounts of gold. The U.S. government still spends far more money than it receives. Geopolitical tensions remain elevated with uncertainty about trade policy and global conflicts driving safe haven demand. For silver specifically, the supply squeeze is not a recent development. For 4 consecutive years, global demand has exceeded mine output, creating annual shortfalls averaging about 170 million ounces. The Silver Institute expects 2025 to mark the 5th year in a row of deficits. China has reclassified silver as a strategic material and is restricting exports, fragmenting the global market, and exacerbating supply shortages. Between early and mid-January 2026, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery from COMEX. That meant roughly 26% of COMEX's registered inventory disappeared in a single week. Silver lease rates exploded to around 8% compared to the typical 0.3 to 0.5% range, signaling the market is short of silver to a clearly abnormal degree. Here's my assessment of the situation. I assign roughly a 65% probability that silver recovers above $90 within the next 60 days. The structural supply deficit, central bank buying, and industrial demand from solar panels, AI infrastructure, and electrification have not changed. What changed was the speculative positioning, which has now been violently reset. However, I also assign about a 25% probability that we see another leg down toward the $65 to $70 range as remaining leveraged positions unwind and the market fully digests the implications of a Warsh-Fed chairmanship. There is perhaps a 10% chance of a deeper correction toward the $55 200-day moving average if economic data disappoints or if the dollar strengthens significantly. For investors considering action, here are the specific levels to monitor. On the upside, watch the $87.54 resistance level. A clean break above that opens targets in the $92 to $100 range. On the downside, $81.51 is the first key support, followed by $76.45 and then $70.81 at the 50-day moving average. A break below $70 would signal potential for a deeper correction. If you are looking to establish or add 2 positions, consider scaling in rather than making one large purchase. The volatility we just witnessed is unlikely to disappear overnight. Advisors typically suggest allocating no more than 10 to 15% of a portfolio to silver specifically, and capping overall precious metals exposure at 20%. I want to be crystal clear about the risks here. Silver just experienced a 6 sigma event, a statistical impossibility under normal conditions. The precious metals market remains in a state of elevated volatility. If the Fed pivot does not materialize as expected, if inflation cools faster than anticipated, or if the dollar strengthens significantly, silver could face additional pressure. The $55 level at the 200-day moving average would be my line in the sand. A sustained break below that would force me to reassess the bullish thesis entirely. Now I want to hear from you. Did you get caught in this silver crash, or did you manage to avoid it? Are you viewing this as a buying opportunity, or are you staying on the sidelines until the dust settles? Drop your thoughts in the comments below, because I read every single one, and your perspective helps everyone in this community make better decisions. Here's what I will leave you with. Diego Franzen, head of portfolio strategies at Plenisphere Investments, said something that perfectly captures why precious metals matter in today's world. In a world where almost every financial activity incorporates credit risk, gold and silver remain the only assets without a counterparty. They make no promises, pay no interest, and are not dependent on political decisions. They simply exist. And that is precisely why they provide security. The silver crash of January 2026 will be remembered as one of the most dramatic corrections in precious metals history. But history also shows that panic selling into a structurally intact bull market creates opportunity for patient investors. Prices should recover as the market digests the news and recognizes that geopolitical dangers, fiscal deficits, and central bank buying have not changed. If you found value in this analysis, smash that subscribe button and turn on notifications so you never miss these market-moving insights. More deep dives on precious metals, currencies, and global markets are coming your way. This is educational content only and should not be considered personal financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions.